Hi class, and welcome to this video, which is going to explain the concept of aggregate supply and all the factors that impact aggregate supply. And this is part of Year 12 Economics, Unit 3, Outcome 2. What do I hope that you get out of this video? Understand two key knowledge points. You understand the importance and meaning of what aggregate supply is, and the factors that are going to influence it. And we're going to go through a number including the changes in prices, quantity and quality of factors of production, the cost of production, technology changes, productivity growth, exchange rates, and climatic conditions. So there's a number of factors that impact the aggregate supply, and we're going to introduce you to what we mean by the aggregate supply curve, which looks a little bit different to other supply and demand curves that you've seen. Now this is part, as we said, of Unit 3 Outcome 2, many key knowledge points, and we are at key knowledge point 7 and 8 here, and we know there's a number of key knowledge points in this outcome. But what is aggregate supply? Aggregate supply comes down to this concept of gross domestic product, or is linked to the concept of gross domestic product, which we understand is a measure of the total amount of production that occurs in an economy over time. So how much production can occur? This is affected by lots of things: economic activity, the amount of goods and services demanded, which is aggregate demand, and there's a separate video on that, but also the amount of goods that can be produced. And this is what we mean by aggregate supply. Aggregate supply represents the total amount of goods and services that all suppliers have produced and supplied over the period of time. So if we're thinking about, for example, a year, how many goods and services have been produced in that time? This is a measure of the ability of an economy to make available the goods and services to meet demand. Because if we think logically, there is a demand for goods and services. This is our aggregate demand, which is going to impact gross domestic product. But that's only going to be met if it is supplied by the suppliers. And we intuitively, hopefully understand the potential to supply goods and services is limited by the quantity and efficiency of our resources. So we have a limited amount of production that can be created. And this comes down to a concept called the production possibility frontier, which we've introduced to you in Outcome 1. Now this is just about guitars and computers and is demonstrating the opportunity cost between them. But intuitively, I hope we understand that an economy operates similarly. We have the potential to make the amount of goods within this area, and we want to maximize our efficiency, so being some point on this frontier, but we do not have the ability to make the amount of goods and services represented by those crosses because we are limited in what we can make. So understanding that the businesses and government's ability to supply goods and services is linked to now what we're going to call our nation's production possibility frontier, or a better term for that is the productive capacity. The productive capacity is how much can be made in terms of goods and services by the economy. And when the economy reaches the point where it's supplying the maximum possible point at a time, we will suddenly use the term it's reached its productive capacity. We've met the point where all the resources are being employed, productivity is being maximized, we are maximizing the amount of goods and services that can be supplied. Now, understanding that prior to reaching this productive capacity, so prior to maxing out how much we can make, businesses or firms are generally willing and able to expand their production if there's a rise in price or a rise in demand. So if we're not at our capacity and a particular product is demanded more or price has gone up for that, now let's think about in terms of COVID, they were products like face masks and toilet paper and stuff. Businesses are able to produce that. But as the economy reaches or nears that productive capacity, we might have some difficulties in meeting our needs unless something changes. And this is where we get suddenly introduced to what we call the aggregate supply curve. And I hope the first thing you're noticing is it looks different to most supply curves, which goes up, but in a straight line. Our aggregate supply curve looks a bit like an arm with an elbow. It is curved. The law of supply, however, still applies. However, instead of thinking about the price of a product and quantity traded, just like aggregate demand, our axes are going to be general price level and real GDP. But just like demand, there's going to be not an inverse relationship, a direct relationship as the general, so I'll fix that up for you so it's clear. As the general level of price decreases, so as the price levels go down, so we'll be going down this way, the total amount of goods and services supplied will also decrease. And we can see that here if we go from this point to that point, we are having a reduction in the amount that's being supplied. As the general level of prices increases, we are going to have an increase in the total amount supplied. But importantly, what we are hopefully intrigued by is why is this supply curve curved? Let's think about this Keynesian curve. How do we explain it? Why are there what I'm going to call three sections to this curve? The first one you might realize is the aggregate supply curve is relatively flat. This is where GDP is low, and the economy is assumed to be operating at below capacity. Because it is at below capacity, firms have the capacity to increase their output easily, and it is assumed this would not require an increase in a price level to do so. So what we're meaning by here is there is capacity in our economy. So even just very, very small price increases, and we'll just do a very small one here, you can see, and it's almost so flat it's hard to say, is going to allow us to do very large quantities supply increases. Because there is capacity, so suppliers are willing to produce more if there is more demand, even if there's no or tiny price rises. As we get to section 2, the aggregate supply curve, I will say, rises like an elbow. The economy is getting closer to its productive capacity, and it's starting to see some bottlenecks or inefficiencies, some difficulties. As workers, and I should fix that up, workers bargain for higher wages due to less available labour, cost of production increases at this stage, and the firms, because of these bottlenecks, these increased costs, will only increase aggregate supply as they know they can sell their goods. As prices rise, they're only going to increase their supply with bigger price rises. So if we think about a price rise here, we're going to need a much bigger price rise in section 2 to have an increase in supply. There is not that giant incentive to firms or businesses to produce more. They will need to see bigger price rises because they're getting to the point where there's some difficulty in doing it. Now, section 3 is where the curve is vertical or straight up. The economy has reached its productive capacity. It is now impossible for firms to increase their output. So it is not possible to produce at this level. Even if the price rises significantly, and we can see a big price rise here, you can see that there is no change in the quantity that's been created because we haven't got the capacity. And hopefully that explains why we have a slightly different aggregate supply curve. And this slide, you might want to pause, explains it. There is much capacity in section 1, high unemployment, low inflation. The ability to make more is an easy proposition for businesses. Limited excess capacity means that they are only going to keep producing more goods if they get to see price levels. And then there is no excess capacity at these price level, at this real GDP value here. So you can see this economy's productive capacity is $400 billion worth of goods or services. They cannot create more than that. So what are the factors that affect aggregate supply? We are going to go through 7 of them. The changes in general price levels, we are going to say creates a movement. So there is no new curve, but does change where we are at in that point. And then 6 other factors that result in a shift. And these are quantity and quality of the factors of production, cost of production, technology changes, productivity growth, exchange rates, and climatic conditions. So the first one we're not going to talk about too much, which is changes in price levels. This is just recognizing, as we have our chart here, because there is price and GDP here, as price changes, we're going to move either up or down or move along the aggregate supply curve. What we are really interested in, what are the factors that are going to create a different supply curve or create a shift in the supply curve? If we have a shift to the left, we are going to be saying that at any price level, there is going to be less goods and services supplied. So shift to left equals at same price level, less goods and services supplied. And that's a little bit messy, but I hope that makes sense. If we have a shift to the right, some factor has come along where we have a shift to right, which means at any price level, there is going to be more goods and services supplied. And this is when we also start to recognize that these aggregate supply curves work in line with the aggregate demand curve, which we know is downward sloping. And we're going to start to see different equilibrium points. So if there is a shift to the right, we're going to go from this equilibrium to this equilibrium, meaning that there is going to be more goods and services supplied and our prices are going to go down because supply has increased with no change in demand. In here, we are going from this point to this point. So if there's a decrease in aggregate supply with no change in demand, we're going to have less goods supplied and a price increase because demand is staying the same. So let's think quickly about these factors that influence aggregate supply. The first 2 are quantity and quality of the factors of production. So the quantity and quality of the resources that go into producing goods or services. If we have quantity of resources, if more resources are discovered, if, for example, labor increases because of immigration, the quantity of the resource increases. Logically, if we have more resources, we are going to have more productive capacity and hence more aggregate supply. There will be a decrease in the quantity of resources, leading to a decreased productive capacity and a decrease in aggregate supply. The quality of the resources recognizes if we have better resources in our production, we are going to become more efficient. So if the quality of resource improves, for example, we have more skilled labor or better technology, this reduces the average cost of production per unit and hence increases aggregate supply because we're prepared to make more of it because it's cheaper. So we can see this will either create a shift to the right if we have increased quantity or decreased quality. And as you can see here, an increase in quantity or quality will shift to the right, and a decrease in the quantity or quality of resources will result in a shift to the left. The cost of production is linked to that, but let's just make it as a separate one to really hone into it. If we have an increase in the cost of production, such as labor, land, and capital, this will shift the aggregate supply curve to the left because we'll produce less at all prices that we can sell it at because it's costing more of us. So we're going to be getting less gross profit for each product sold. As we mentioned, this is because the increased costs will make it less profitable for us to supply the product in the market. Now, the opposite is true, of course, if costs of production decrease, and businesses are always trying to do this, then they will make more profit, so they'll be prepared to supply more at each price level. So, for example, the falling or rising oil prices, labor charges, technology prices all impact aggregate supplies, and that's why businesses need to be thinking about them. So a decrease in cost of production will result in a shift to the right. We're prepared to make more goods and services at any price level. And an increase in cost of production will result in a shift to the left of our aggregate supply curve. Now, technology changes is one where, as we recognize that new advances in technology, which has been significant in the last decades, the changes in technology, how goods and services are produced, this impacts and generally increases the productivity of the existing resources that we have. So essentially, we're creating better quality resources. We can make more, we're more efficient. So as technology improves, we're going to have a shift to the aggregate supply curve to the right, because generally we're going to have lower production costs. We can just make more of it. So for example, internet and the mechanization of and automation of our production process has significantly reduced the cost of production, increased productivity, leading to a shift to the right of our aggregate supply curve. So increases in technology are going to shift to the right. In a very unlikely situation, if we had a decrease in our technology, and you can see I've said that this is an unlikely scenario, this will result in a shift to the left of our aggregate supply curve. So productivity growth, as you can see, it's all linked to our cost of production and efficiency. Productivity measures the output per unit of input. How much can we make with our resources? And technology is linked to this, is going to increase our productivity. Productivity growth, if we can make more with what we have, it's going to lower our costs per unit and will increase aggregate supply. So our cost of production will fall because cost of units decreases. We can produce more goods with our existing inputs. This is all going to increase product capacity, make suppliers be more incentivized to make more goods at each price level. So if we have an increase in productivity, we will have a shift to the right. And a decrease in productivity, we will have a shift to the left. Now, exchange rate is one that we haven't talked too much about yet, and that's because exchange rates is all about macroeconomics. Exchange rates measure the value of one currency in terms of another currency. For example, the Australian dollar at the moment will roughly buy you 74 US dollars. Now, the important thing to recognize is that we have floated our Australian dollar, which means it changes over time. And it can change quite a bit if you look at the historical Australian dollar to US dollars. Now, depreciation in the exchange rate means the value of our Australian dollar will fall. So, for example, instead of being 74 cents, maybe you can only get 60 cents for your Australian dollar. If it falls, we are going to be more competitively internationally. People internationally are going to be more prepared to buy our goods because it's going to be cheaper for them. Because they're going to, for example, hand over $1 and it's going to be worth more here so they can buy more goods or buy them cheaper. Now, because of that, our exports will increase and our imports will decrease, thus increasing aggregate demand. And an appreciation in exchange rate, such as our Australian dollar rising, will make it relatively cheaper for producers to purchase imported units. So probably more interesting for suppliers is how is it going to impact the cost of our imports? So if we have an appreciation of an exchange rate, our Australian dollar is worth more, our suppliers will be able to buy the inputs from overseas cheaper, their cost of production will decrease, and hence aggregate supply will increase. So to repeat that, if our Australian dollar rises, we have an appreciation. Our suppliers who often need to get inputs from overseas will be able to buy them cheaper, making their cost to production cheaper, and their aggregate supply will hence go up. Now, of course, if we have a depreciation of exchange rates, our Australian dollar falls, the goods that suppliers are trying to buy as part of their production process will become more expensive, leading to a decrease in aggregate supply or a shift to the left. So an appreciation in the exchange rate will result in a shift to the right. A depreciation of the exchange rate will result in a shift to the left. I think finally we come to climatic conditions. We know that all the raw materials that suppliers use in their production process often come from nature. And these are heavily dependent on having favorable climatic conditions to be produced. Now, if there are unfavorable climatic conditions, this is going to reduce the availability of that resource. And if we have scarcity, the price will go up. This will raise the cost of production for our suppliers, and this will decrease aggregate supply at all price levels. For example, the droughts in Australia, for example, or floods at the moment are unfavorable for climatic conditions, and they're going to reduce the availability of natural resources. If we have favorable climatic conditions, this is a good thing. We might have bumper crop yields or whatever. This is going to reduce the cost of production because there's so much in the market, and this will increase aggregate supply. So favorable climatic conditions, shift to the right. Unfavorable climatic conditions resulting in a shift to the left because of increased cost per production. Favorable climatic conditions result in a decreased cost of production, so a shift to the right. Now, what are the other government efforts to boost aggregate supply? What do other governments do as well to try and make their economy have a better productive capacity, able to produce more and willing to produce more goods or services? They often do things like try and upskill their labour force, provide assistance to businesses that are affected by climatic conditions. They might subsidise production if they think it is a really beneficial product that they're producing, or they might look to protect local producers from cheaper imports through tariffs. They also make laws to try and promote competition, so they do a number of things, and just invest in infrastructure to promote productivity growth. Now, you don't need to know these ones because they're not specifically in your study design, but I did think it would be useful to put them in, so I've skipped over them. But governments do a lot of things as well to try and increase the productive capacity of an economy, because that's going to drive economic growth, improve living standards, so they do try and do those things. Now, if you're wanting to have a look at my future slides, you're more than welcome to skim through these. This explains what happens if we have favorable aggregate supply conditions. So what happens when we have a shift to the right? And what happens when we have less favorable aggregate supply conditions? So a shift to the left. And you might want to pause the video and have a look at those ones. But for now, I hope that you've understood the aggregate supply and understood the factors that affect aggregate supply. And you're leaving this video understanding the aggregate supply curve and why it really is a curved supply curve. You understand what we mean by aggregate supply. This is how much an economy is willing and able to produce goods and services at different price levels. And logically, as price goes up, businesses are wanting to produce more goods and services, but it is capped at a certain productive capacity. But there are a number of factors that will result in either a shift to the left, so reduced aggregate supply at all price levels, or shift to the right, and we need to know a number of them listed here. I hope you found this video useful and it's helped build your understanding of aggregate supply.